All finance is centered around two fundamental premises: what you make and what you keep.
The more you invest, the less you pay the IRS.
You can't build generational wealth if you're unwilling to hold assets for a generation.
Facts. We're gonna talk about 5 investment accounts that you must set up before the end of 2025 so that you can maximize your investments and minimize your tax savings. Now, can I give them a hack that we only give our clients?
Why not? Why not?
Okay.
Why not?
Now,
what's going on, everybody? Welcome back to a special segment of the Melanin Money Podcast live at the New York Stock Exchange.
feels good to be back.
Feels good to be back.
Yes.
Right, we got to make this a regular. Well, at this point, it is a regular thing.
It is a regular thing, but it's a little while since we've been back.
Yeah, so we're glad to be back in the mecca, right, of our industry. At least for me, right? I know we still got to go make our way to the IRS office.
No, we don't. I'm good right here. I'm good right here.
Okay. So now we're excited to be back, and the reason why we love these segments is because it takes us out of our comfort zone, allows us to, dive a little bit deeper into some of the topics that really give you guys insights on how to invest, the different account types you should be using, specific investments that we have our eye on. And today we're going to start with the accounts, right?
Yeah. So one of my favorite quotes is that the more you invest, the less you pay the IRS. There are ways that you can legally invest your money today while simultaneously paying less taxes tomorrow. But most people don't know which accounts to set up to invest in so that they can increase their net worth and minimize their taxes at the same time. But today, we're going to talk about 5 investment accounts that you must set up before the end of 2025 so that you can maximize your investments and minimize your tax savings.
Absolutely. And the reason why this is an important way to look at it is because most people think when it comes to tax deductions, they just got to find something to spend money on.
Yeah, no.
Let me buy the G-Wagon, and I'm going to still have payments on the next year.
Yeah.
Right, let me buy some office equipment, and those things could be legitimate and good expenses that you might need. But personally, if I can buy an asset that's going to continue to appreciate, continue to build equity, and the IRS is going to give me an incentive to do so, I'm taking that deal every day of the week and twice on Sunday.
Twice on Sunday.
Okay. So let's talk about the different account types that people should open up or consider having before the year is up.
Okay, so the first account is for everybody, whether you're a business owner, whether you're a W-2 employee, depending on, everybody can have these accounts. And that is a individual retirement account. So there are 2 types of what we call IRAs. There is traditional IRAs, and then there's Roth IRAs.
Right.
And the difference is very simple to understand. With the traditional IRA, you get a tax deduction today for the money that you contribute.
Yep.
But you will pay taxes later when you withdraw the money out. With a Roth IRA, it's the exact opposite.
Right.
You don't get a tax deduction today, but the money grows tax-free forever, right? So these accounts, anybody can set up, and in 2025, the limit for contribution is $7,000.
$7,000.
So you can put $7,000 in an IRA or $7,000 in a Roth IRA. But here's the thing. People ask me all the time, can I have more than one IRA? And the answer is yes, you can have 7,000 IRAs. But you only can put $1 in them a piece because the max across all of your
I like what you did there. 7,000.
Yeah. The max across all of your IRAs needs to be $7,000. So IRAs is the first account that everybody should set up. Now here's the biggest misconception I want you to talk about, George. The biggest mistake that we see when people open up IRAs is they fund the IRA and they think that funding the IRA is investing in the IRA, and those are not the same thing. Am I correct?
Not the same thing. Okay. And it's funny, people even position it like, hey, how can I get one of those IRAs? Thinking that the IRA itself is the thing that makes it grow. I was like, yeah, you can get one of those IRAs, but no, the IRA, right, the traditional Roth, that's just, let's look at it as the bucket, right? And then you fill the bucket with stuff, right, with the money, but then ultimately you still have to make the transaction and buy the stock, right, buy the shares. So what happens is people transfer the money from their bank to the IRA, but they forget to actually purchase the investments, right? Because your IRA can just be held as a money market fund if you don't purchase investments. I think many people miss the mark on that, and that can be painful, especially if it goes, multiple years. You look up like, why is my money the same as what I contributed?
Yeah, I think we had a client, if I'm not mistaken, it was a couple of years ago, that said her IRA was underperforming.
Yeah.
And then when one of our advisors looked at it, we said, well, we figured out why. We figured out why your IRA is underperforming. Because she had funded the IRA, but she didn't select any investments.
Now let's just be clear. This is a client that came to us.
New.
Not a client that had her IRA for 2 years and was working with us. No. Because we wouldn't recommend hiring us if that was the case. And it's an easy mistake to make, right? So there's 3 simple steps. First, we have to understand how the IRS is going to treat this account. Do I want it to be the money to grow on a tax-deferred basis and be taxed when I retire? Or do I want to take the tax hit right now and not have to worry about taxes? That's the first thing. Then we pick our account type based upon that. Then we have to fund the account with cash from our bank account, and then we purchase the respective investments.
Yeah.
So those are the 3 steps, right? Make sure you do that third step, please.
Yeah, please do that third step.
Yeah.
So that.
Now, there was one caveat, right? So, like you mentioned that with the IRA, this is a max of $7,000, right? But if you have an employer-sponsored plan, right, aren't you able to contribute the max of the employer-sponsored plan in addition to the individual retirement account?
We go. That's next, brother.
Okay. All right. Yeah. All right. Just making sure.
Okay.
For the horse.
So the next account we're going to talk about is a 401k. Now, there are different types of 401ks. We're going to talk about 2. There is a solo 401k, which is for business owners.
Yep.
And then there's the traditional 401k that you can get through your employer. So let's start with the employer, then we'll back into the solo 401k. So when you have a job and you're an employee, your job they don't have to,
right,
but they can offer you a 401k plan.
Yeah.
And with the 401k plan, you are able to contribute up to $23,500 as the employee. So you as the employee can have money taken out of your paycheck and contribute to this 401k, $23,500. But on top of that, your employer can decide to match your contributions up to an additional $46,500. So the maximum you can put into a company 401k is $70,000. So what you want to do as a W-2 employee, if you are an employee, you want to make sure that you're at least investing into your 401k up to the match. Is that
right?
Is that a fair assessment?
That's a fair assessment, correct.
Okay.
Yeah, and so here's the thing, guys, too. So to Carter's point, your employer is not obligated, right? Hopefully, they're a good employer and they match. We actually have a 401k plan. We match for our team members. But they're not obligated to, right? And so to Carter's point, the first line of defense is let me take advantage of that free money, right? Because if I invest, they match dollar for dollar, and I invest $10,000 into my 401k, that means if I get a 0% return, my money's going to be $20,000 at the end of the year, right? So we 100% want to take advantage of that. The question we also often get is, which is better? Should I only focus on a Roth IRA, or should I focus on a 401k or a traditional IRA? And we think that you can do both. But just be strategic, right? You don't want to put all your money into traditional retirement accounts. Why? Many of our clients retire early. And there's provisions that say if you access the money before age 59 and a half, you'll be penalized. So we're not saying that you shouldn't put money in it. We're just saying balance out what makes sense, right? Because you're going to get taxed later. So we got to factor in what is tax law going to be years from now. I'm not a betting man, but I believe taxes may be higher in the future, right? But at the same token, how do we balance qualified dollars that go into those accounts versus non-qualified dollars that we don't have to worry about being taxed? You just play the balancing act, right? That's just my general rule of thumb.
Yep, love it. So within these accounts, we're gonna talk about now accounts specifically for business owners, which is probably my favorite retirement account, which is called a solo 401k. So I'll tell you all this, with a story. So we had a client that was leaving their job and starting their own business, right? They were afraid to leave their employer, not because they didn't think they were making any money, but because they was like, well, as a business owner, I can't have a retirement plan, so how am I gonna stay on track for retirement? And we were like, who said that once you start a business, you can't have a retirement plan?
Right.
And I think a lot of starting out entrepreneurs or veteran entrepreneurs don't realize that they can set up their own retirement plan. Right. And our favorite retirement plan is a solo 401k, right? This is a 401k that you set up for yourself and that you 100% own. And what's amazing about a solo 401k is that you, as the employee of your company, because you're both the employee and the employer of your company if you're an S corporation, you can fund your solo 401k with $23,500 as the employee, but then you can match yourself as the employer and fund an additional $46,500, I believe, into this account. So you can match your own contributions and you can max out your 401k at $70,000 a year. Do you know how fast you will hit your retirement financial freedom number if you're putting away $70,000 a year? Not to mention you're getting a $70,000 tax deduction the same year you make the contribution.
Facts. And when most people, when they hear that number, they might say, oh, 70,000 seems like a lot. But what you're not realizing is if you don't put the money somewhere, Uncle Sam's coming for it anyway.
Taking it.
So when you now can connect the dots, say, oh, shoot, by having this account type, I can reduce my tax liability as an entrepreneur, fund my retirement so that I'm not giving this money to Uncle Sam or purchasing unnecessary expenses. So I want you to think about it from that lens, because I know 70,000 might seem like a big number, But when you realize the money is probably going to get spent anywhere, if you're a multi-six-figure or seven-figure entrepreneur, you can rapidly get to your freedom target so much faster.
Yeah, and another benefit of a solo 401k is depending on who you set up your solo 401k with, you can set up what's called a loan provision, right? Now, one of the main reasons people don't invest their money in retirement accounts is because they feel like they can never touch it. I can never touch it. I can never get it back until I'm 59 and a half.
Right.
But what's key with the solo 401k, when you set it up with a loan provision, the loan provision allows you to borrow from the account up to $50,000 or 50% of the portfolio, whichever is less. So if you're a business owner and you're saying, hey, I want to invest in a solo 401k, but what if I need some of the money next year to grow and scale my business? You have a $50,000 loan that you can take out at any point. And as we know, loans are not taxable. So now we have tax-free money that we can take out, reinvest into the business. And yeah, we have to pay the loan back, but we're paying interest back to ourselves versus paying to a bank.
Absolutely, and we love the solo 401k for that very reason. And here's the other thing too. So depending upon how your business is set up, obviously it's in the name. It's a solo 401k. So if it's you and you have a spouse, you can benefit from it. If you have employees, it may not make the most sense. However, depending upon if you have a great team, like me and Carter have a company of over 40 employees at this point. Yeah. But because of how we have it set up, we both have solo 401ks.
Yeah.
Right, and that's another episode for another day.
Yeah.
But it is a great tool for building your retirement income, and also saving money on taxes simultaneously, which is why we say there's no line in the sand of just put money in the Roth or just put money in a traditional retirement account. They both have different use cases for different reasons, and we just want to diversify, not to mention that we can do things like backdoor Roth conversions as we get closer to our retirement date, which is also another episode for another day.
Yeah. I was like, hey, leaving a lot of cliffhangers today. Leaving a lot of cliffhangers.
That means you guys just got to come back, right? Stick around.
I'll get comfortable. All right. Account number 3, which is one of my favorite accounts because this account has a triple tax benefit. There's very few accounts that you get the benefit tax-wise 3 separate times, but this account is one of them. Yeah. And I'm talking about none other than the HSA, a health savings account. So what is the HSA? Let's break it down. If you're an employee or if you're a business owner, you can have an HSA. The only requirement in order for you to have an HSA is for you also to have what's called a high deductible health plan, which if you look at car insurance deductibles, all that means is that you have to have a deductible that's higher than a certain amount for you to have this HSA account. So you can go to your employer and say, hey, I want to change my health plan from what I have to a high deductible plan, which will make me eligible to have an HSA.
Right.
So once that is done, once you have a high deductible health plan, you can set up an HSA. Now, why would you want to do that? Well, like I said, HSA has a triple tax benefit. Tax benefit number 1 is you get a tax deduction for the money that you contribute, right? If you're single, you can contribute up to $41,050 in 2025. If you're married, that doubles at $8,300. So you can put away $4,000 or $8,000 into this account, and you get a tax deduction for the money going in, okay? Now, when you put the money in the account, like George said earlier, you want to invest it, right? Because so you can invest this money in the S&P 500 or other various stocks, and that money grows over time because it is invested, and it's growing tax-free. So you get a tax deduction for the money going in, the money grows tax-free, and then the third tax benefit is if you use this money for health-related expenses, that money is tax-free on the way out. So you get a tax deduction for the money going in, it grows tax-free, and if you use it for health-related expenses, you don't have to pay taxes when you take the money out. Now, here's what most people don't understand. Most people think health-related expenses is like you going to the doctor and get major surgery.
Right.
That's not the case.
Facts.
You can use your HSA for going to the dentist. You can use it for going to the eye doctor. I use it for my prescriptions. You can even use it to buy different frames for your glasses as long as they have a prescription in them. So with HSAs, you have a plethora of different expenses that you can use. In some cases, you can use it for therapy, right? So you have this account. So in my opinion, there's no way that you won't find a way to use this money on health-related expenses so you can take advantage of the triple tax benefit.
Right, and that's a fact. And guys, you got to remember, if we're talking about all these different account types that you're going to set up, right, all you have to do at this point is now you're earmarking a portion of the money you're going to need for retirement anyway for health-related expenses.
Yeah.
And be like, oh, well, if I put all this money in the HSA, what if I don't need? Trust me, you're going to need.
You're going to need it,
right? And so now you'll just know, okay, when I'm looking at my retirement income, I need $7,000 a month, right? 1,000 of that is going to come from this account because for my health-related expenses, 3,000 is going to come from my living expenses over here, and you're just earmarking what the different account types are going to serve in retirement. Right. So that is one of the top accounts that I personally love at HSA, because most people don't realize it's underutilized. It gives you a tremendous benefit. And on top of that, you can offset your health expenses as you get closer to retirement.
Now, can I give them a hack that we only give our clients?
Why not? Why not?
Okay.
Why not?
Now, with HSA, most people think that, oh, I have this money invested in my HSA, a health-related expense comes up, so I want to swipe my HSA card to use it so that
I know you're going with this. Yeah,
right?
Yeah.
So we tell our clients, because they're working with top-notch advisors, they say, hey, John, I know you have that health-related expense. We're not going to use your HSA for the health-related expense. Carter, why not? Because the more money we keep in your HSA, the more it's going to grow over time. Compound interest is one of the strongest forces in the universe. So we say, hey, don't use the HSA, pay for that expense out of pocket, because we're going to keep this money in the account so that it can grow faster and grow larger. And then once 10, 20, 30 years from now, whenever we want to, the IRS allows us to backdate and pull out the money from our HSA and reimburse ourselves for the health-related expenses that we pay for out of pocket. So if your HSA was $10,000, let's say this year, but 20 years from now, it's at $300,000, but you spent $75,000 during that time on health-related expenses, you can now cut yourself a check, tax-free check from your HSA for $75,000, take that money home and use it for whatever you want, because that money in your HSA grew so much faster because we didn't interrupt the compound interest.
That's a huge caveat, right, guys? So, like, just imagine that. Because your health expenses are going to be little odds and ends, a couple $100 here, deductible there, right? And so imagine not interrupting the compound growth of the account, being able to keep record, right? You want to have good records, keep record of the expenses, right, that you had associated with that, and then retroactively being able to get that money back after you've been able to take advantage of the compounding. Because here's the thing, if you would have took the money out in real time, you would have eliminated the compounding at that moment. Now the money gets to stay invested. You still get the same benefit of leveraging the money for health-related expenses, all while your money was able to grow and thrive for several years. I mean, guys, like, I don't know what better benefit you can have than that.
Yeah, and if you want to learn more strategies like this, click the link in our bio. Click the link in this video. We have a 5-day wealth workshop we put on a couple of times a year, breaking down some of these strategies if you want to. Now,
what's up, YouTube family? Thanks so much for watching the show. I hope you are enjoying this episode. But if you are watching this, there's actually a 70% chance that you're not subscribed to the channel. And that's okay. We appreciate you for watching and listening. However, if you wouldn't mind hitting that subscriber button, it'll let YouTube know that other people are interested in this show so that we can further spread the message of money.
And if you're ready to start learning how to build wealth and save on taxes, we highly recommend you join our Multiply Your Money Challenge. This is a 5-day virtual event where both me and George are going to be teaching you the advanced tax and investing strategies of the 1%. And we highly recommend that you grab a VIP ticket, because both me and George are going to be answering your personal financial and tax questions. That link can be found in the show notes below. Can't wait to see you there.
Peace.
Number 4. So I really didn't like this account. On that I have number 4 on the list.
Yeah.
And the reason is because I felt like where the economy is going, where the future is going, is that college will not be a mandatory thing in the future.
Right.
However, this past year with the new tax updates, they made this account sexy again. And I'm talking about none other than the 529 plan, right? 529 plans are ways for parents to be able to save for their children's college and get a tax deduction, a state tax deduction, depending on where you live, for the money you contribute. The money grows tax-free, and then you can use the money tax-free as long as it's been used for school. Now, you can use 529 plans for high school, private school, college tuition. It's a wider scope of tuition than just college, which is great. But with AI and ChatGPT, I don't know how long college is going to be around.
Right.
So if you put $50,000, $100,000 into this 529 plan over time, and your child says they don't want to go to college, that money is now taxable.
Right.
However, recently the IRS gave us an updated regulation which says if your child does not use the money in their 529 plan for college, you can convert $35,000 or whatever's in that account to a Roth IRA for your children, and that money can continue to grow tax-free forever.
You gotta love that. You gotta love that, right? So you still have the ability to have the foresight to make that investment for your kids, right? Because even as a financial advisor, I was against that account type as well because it just doesn't give you maximum flexibility.
Yeah.
But now knowing that money can be converted into a Roth IRA and not be taxed in the future, I think is a tremendous benefit because you're still earmarking the money for your children while still not being concerned. And it might just be a knucklehead. It might just not want to go to school, right?
School ain't for this one.
Yeah.
By age 5, school ain't for this one.
Right. And so now you don't have to worry. You have a viable alternative. And that's why it's so important just to understand the tax code, understand how these strategies can apply so you can set these things up in a way that can be meaningful for you, your household, and your legacy, right? Oftentimes what we see is people have a lot of, clients before they become clients, they have these different financial puzzle pieces, right? It's like, I put a little bit of money in the 529. I put a little bit of money in the Roth IRA. I think I have an old 401k from 3 jobs ago that's still there.
Still sitting there.
Now, let me say this. If you left that job, why would you leave your money there? Why would you leave your money there?
You don't want to be there.
You don't want to be there.
You don't leave your money. You leave your
Right?
dollars there.
No, but I'm not going to spill Arcane in the lobby. We got a really exciting campaign coming in top of the year because we want to get that money back.
Okay?
Let's keep that close to the chest. But that's going to be fun. We have to get in the best shape of our lives for that campaign.
Yeah,
okay? But anyways, guys, so we love the fact that you can leverage these accounts to do what you want to do. To get to your desired outcome. But if you don't know the functionality, if you don't know the tax treatment, if you don't know the provisions, you're not going to be able to maximize it, which is one, why we do this show, right? And two, which is why we help our clients implement these strategies so they don't have to do it on their own.
1,000%. Now I'll let you talk about this last one because it's your bread and butter, this last account.
Absolutely.
Yeah.
All right, so when you think about investing, there's a lot of drawbacks that people might have, right? Drawback number one might be they feel like the money's locked away. So they're like, I don't want to put the money there. Drawback number two is like, well, it's gonna be taxed, so I don't want to put my money there. And so when you think about investing, one of the things you want to factor in is how can I get maximum flexibility with my desired outcome? Again, many of our clients are what you call financially independent, retire early, right? They have no desire to wait until age 59 and a half to retire. It doesn't mean they're not going to live beyond age 59 and a half, which is why we still have money invested in solo 401ks, IRAs, et cetera. However, we want to make sure that we have access to resources preemptively because they're going to retire faster. So this account type is none other than a taxable brokerage account, right? And so the great thing about a taxable brokerage account is there's no limitations on how much you can invest.
No limits.
Right? Whether you want to invest $7,000 a year or $7,000 a month, right? You can invest whatever you want and max out this account because there is no max. So we love that for that reason. Number two, right? Now, if you were to sell any of your investments, right, unlike a traditional 401k, you would be taxed, right? So we often hear people preach about generational wealth. And one of the things we say within our company is you can't build generational wealth if you're unwilling to hold assets for a generation.
Facts.
And you might say, well, George, shoot, I want to benefit. I love my kids. I know you love Legend, but don't you want to access some of that money too?
Yeah.
Absolutely. But the benefit with a brokerage account is you can borrow against the value of said account. So with the solo 401k, you're borrowing from it. What does that mean? I got $100,000 invested. I'm taking out $50,000, right? Cool. Your account, you still have $50,000 in your account, is growing and thriving. You pay yourself back over time. Use that money to invest in your business. Use that money to invest elsewhere, whatever you want to do. When you're borrowing against the value of your account, that account now effectively becomes collateral, right? Okay, so the investment institution, Charles Schwab, Fidelity, what may have you, says, I see you have the equity there. And so I'm willing to give you a separate line of credit because I know you have the money. If you try to run off on this loan, it's okay. Listen, I own the company. I am leaving with something.
Let me get that back.
And here's what they know. They know that you don't want them to sell your shares, right, that you've been holding and investing, and you don't want them to. So you're going to pay them back, and ultimately they give you that line of credit that's based on the value of your account. And why is that super valuable, right? Because now, let's say you had $100,000 invested, it gets to continue to grow and thrive, and now you get an access to a line of credit, let's just say $50,000. You get that line of credit, the first thing you need to know is you're not paying any taxes on that money, right? That's the first thing you need to know. The second thing you need to know is you can do whatever you want with that money. Now, obviously, we are recommending that you are buying other investments that produce cash flow, maybe investing into a privately held business that you can own, maybe buying some real estate. But you can do whatever you want, even if you have high interest debt, right? You say, I want to consolidate that and I want to make it more simple. You can do whatever you want with that money. So it gives you maximum flexibility and you get to avoid taxation in the process. The last benefit, especially if you're buying assets, is you get to take the money that the asset is producing and then be able to reinvest some of that money back into the portfolio because now that account effectively becomes your bank. Because why would you put the money back into your bank? Because what happens when you put your money in the bank, right? Whatever you take out is gone. You got $100,000 in the bank, you take $50,000, it's gone. It's gone. You put that money into your investment account. Number one, you're not getting, with your bank account, you're not getting any ROI. Maybe you're getting 1%, 2%. If it's, a decent savings account, most likely less than that. Now your money is compounding, let's just say conservatively at 10%. And then when you need to access the money, you can borrow against your portfolio so you never have to sell your investments.
We should do an episode teaching people how we leverage the strategy to invest and not pay the IRS and still have the things that we want to have. We should do a whole episode about that strategy because I think it's so underutilized, especially in our community. Right. I remember where I was when you told me, so I think we should do a whole episode breaking that down and then give an example of how you did it, how I did it, what it afforded us to buy or invest in, and how we paid it back. We should do a whole episode about it.
We should, because guys, at the end of the day, it's just interest rate arbitrage, right? If it's going to cost you 6%, the cost of capital is 6%, right? Let's just say in this example, cool. You look at that, and what is your monthly cost associated with the money that you're borrowing? The other thing that's underlooked at is what is the return on your portfolio at that time? Because some people say, well, just sell some of your shares, right? Well, why would I do that if my portfolio is doing 25, 30%? And it's only costing me 6% to borrow the money. And let's not even forget to factor in the ROI for the investment we're about to buy. And let's not forget the equity and the appreciation of it, because we typically buy assets for two reasons: equity appreciation and cash flow. Right? So when you just do the math, it's like, okay, you mean to tell me it's going to cost me 6% on this $100,000. You spread that out over 12 months, it's peanuts. I didn't sell my investments, so my portfolio is still growing and thriving at 20-something% or whatever my ROI is. I was able to get access to the money to buy another asset that's also producing cash flow, and it's building its own equity. And not to mention that we don't have enough room on this episode, but you can probably borrow against that asset too.
We
don't. That's more for another day. But what is the underlying principle here? The underlying principle is that the reason why me and Carter came together is we understand that all finance is centered around two fundamental premises, right? What you make and what you keep, right? But if you're not keeping it, you don't have as much resources to invest, right? So what is the number one lever you have to pull to keep as much money as possible? Saving money on taxes. Boom. Okay, we solved the tax problem.
Yep.
Now what? Okay, well, we could buy G-Wagon, we could go shopping, whatever, or we could take that money that we now are not overpaying in taxes, and we can invest that money to accelerate our wealth building with money that we were about to stroke a check to Uncle Sam to. Do we understand how powerful that is? That money was 2 steps out of your bank account going to the IRS. We recaptured that money. That's not even counting the money that you already were planning to invest outside of that. We invested the money, and then because we understand strategies to further leverage the tax code, not just from a deduction standpoint, but leveraging by borrowing the money instead of selling your investments, you also avoid the tax system again, and then still get access to the resources to buy more investments. And this is the reason why our clients are able to retire 3 times faster. It's not fluff, it's not a fancy tagline. It's because we understand the full spectrum of how the system works, right? Wall Street and what street is IRS on?
Main Street.
Main Street. Right? And that is how you win the game at the highest level. It's not working harder. It's not actually the W-2 earner who makes more money gets penalized the hardest.
Yep.
Right? So it's not about working harder or making more money. That is actually not it. It's about understanding the tax code and how you can take advantage of it to invest more money so that you pay the IRS less and win the game of wealth at the highest level.
Well, that was an episode, guys. So do us a favor. If you like this episode, please hit that subscribe button. Please comment below. Should we do more episodes? Just giving you all some of the strategies that we use with our clients. And let us know if y'all want us to do more episodes at the New York Stock Exchange. We can't wait to continue to serve you all. But again, let us know in the comments. Give us the feedback. Other than that, we'll see you on the next episode. Peace.